Matthew Bell with InsurancePrescription.com. Today I want to talk about various misrepresentations, confusions, lies even, that insurance agents might tell to clients in the hopes that some of these might put you on your guard. I do want to express a couple of disclaimers and caveats right from the start. First of all, I am not implying that insurance agents are particularly deserving of disapprobation in this regard. We know people lie. It's not a surprise to us. We could have a video, and I'm sure there are videos, on dishonest car salesmen and vacuum cleaner salesmen and lobbyists and doctors and religious leaders. There's all kinds of people who are dishonest in various capacities. So this is simply informational. This is not an indication that I think that insurance agents are less to be trusted than other professionals. The second caveat is a little bit more complex, and that is that I want this video to focus on those things that would have broad agreement amongst ethical insurance agents and brokers. And what I mean by that is I'm not going to list things that I think are dependent on a certain philosophy that a person might have. So there are a number of recommendations that people sometimes might give based on the set of assumptions and the set of methods or the methodology that they bring to the table. A person who just is down on universal life, or a person who just favors universal life, or a person who's down on whole life and favors term, or who's down on term and favors whole life. There are certain slogans that go along with some of these strategies, but they're dependent on a philosophy. And I believe that a lot of these things are open to debate. And they're going to depend on a kind of a back and forth between the agent and the client. So sometimes the agent and the client both have identical sets of assumptions and they agree on the methodology and it's perfect. At other times they're diametrically opposed and they're like two ships passing in the night. And in some cases, one or the other can bring the other one around to their perspectives. What I want to express here are going to be things that I think are fairly clear-cut and that are not dependent on a set of assumptions. And I think it'll be a little clearer as we kind of move through some of the examples. I'm going to give 10 examples of things that I think are obvious examples of misrepresentations of one sort or other. And they'll be in a couple of different categories. So the first category is essentially going to be over-promising. And my first example of that is going to be the phrase, the policy can pay for itself. So with cash value policies, especially from those companies that are dividend paying, the policy eventually might get to the point where the dividend is capable of covering all or a portion of the premium payment. In the past, I have had people approach me who have told me that their agent told them that the policy would pay for itself eventually. Now, the problem with this is that it's not a sure thing. And so sometimes people, after 10, 15, 20 years, they call and they say, hey, I thought my policy was paid up. Now all of a sudden I'm getting a bill. And what happened was they paid into it for a time. Then the dividend grew sufficiently large to be able to discharge the entire premium bill. But now, based on interest rate, market environment, the company's mortality experience, and various other factors, they're getting a bill for the difference because the dividend is no longer large enough to cover the entire premium. And the answer is that the policy was just never paid up to begin with. It's not a paid up policy unless there's no bill. If your dividends are being used to pay the premium, it's not a paid-up policy. But the second thing, and related to that, kind of an extension of it, is sometimes life insurance agents represent non-guaranteed values as guaranteed. If there is a dividend, if you have a company that's a participating company and you're eligible for a dividend, that dividend is never guaranteed. The value of it is going to tend to go up and down based on the company's market experience, based on the company's mortality experience, and various other factors. When you are looking at a policy illustration, there's going to be one column generally for guaranteed values, other columns that may have various non-guaranteed values. And you want to make sure that you understand. It's often well said that you shouldn't buy a policy based on what it might do, but you should buy a policy based on what it is guaranteed to do. Now, the third category of misrepresentation is going to kind of, again, expand from the first two categories. So here, besides the idea that a person might have a paid-up policy and a policy where the dividends are being used to pay the premium confused, there can be other confusions that arise as well. One common one has to do with annuities. So in an annuity, sometimes people will say they have a guarantee of, and then they'll fill in the blank with some percentage. So they might say I have a guarantee of 5% or 6%. And the question should always immediately be, what is guaranteed? So there's a guarantee that could be on an interest rate, and there's a guarantee that could be on a payout rate. And sometimes those are confused, sometimes they're conflated, and sometimes they're misrepresented. An annuity in general has two different periods. A period which is called the pay-in period, where the money belongs to you. You can put it in, you can take it out. Sometimes there are restrictions that apply, but the money belongs to you. The payout period, on the other hand, is when you literally give the money to the insurance company and then they give you a stream of income in exchange. So, for example, if you have $100,000 and you have a guaranteed 6% interest rate, that means the money belongs to you, $100,000, and you are guaranteed that that year you are going to have no less than $6,000 extra cash credited to your account. But if you have a 6% payout rate guarantee, that means that you have given the $100,000 to the insurance company, and in exchange, they're going to give you $6,000 a year, possibly for the rest of your life, right, if it's a guaranteed lifetime annuity. But those are very different things. The interest rate and the payout rate apply to different periods. In one case, the cash belongs to you. In another case, the cash itself, the annuitized cash, belongs to the insurance company, and you have traded it essentially for a guarantee of lifetime income. Another confusion that arises with respect to annuities can be the difference between an annual average return and a compound return. There are many different definitions that could be applied to this distinction, but the one that I have in mind is essentially this. If you have a compound return, then every year you are having the same return like clockwork. So if you have a 5% compound return, then that means you get 5% year 1, 5% year 2, year 3, year 4, year 5, all the way out. On the other hand, if you have a 5% average annual return, that means that whatever amount you get every year is going to vary. You might get 10% one year and 0% the next year. But we mean that if you take those numbers, add them together, divide by the number of years, you will arrive at 5%. Now, whether that makes a difference to your bottom line is going to depend on factors like, for example, whether you're touching the money, how volatile the instrument is, and some other things besides. But the bottom line is the compound and the annual average are not the same figure, and they're often confused or misrepresented. Now, I have an entire video where I get into that more in depth, and I may pursue the question of the difference between the interest rate and the payout rate in greater detail in another video as well. So stay tuned for that if you would like more information. Now, another category is going to be not disclosing enough information. So my fourth example of a misrepresentation is going to be where insurance agents neglect to mention various relevant legal clauses. Insurance agents are generally not also attorneys. I mean, they may be, but probably they aren't. And so they're not experts in the law. But you have to understand that a life insurance policy or an annuity are legal contracts. And so when you sign them, you have to pay careful attention to the clauses that are in the contract. So a couple of clauses that you might want to pay attention to, you want to read through the thing, obviously, but you want to pay attention to something called the contestability clause. The contestability clause outlines the period of time that the insurance has to dispute a claim. So if the contestability period is 1 year, 2 years, that means that within the contestability period of time, if somebody dies, the insurance company can say, you know what, hold on, we're not sure we're going to pay that claim. We need more information about the case. That doesn't necessarily mean they won't pay. Reputable, ethical insurance companies, right, are not just going to refuse to pay. They wouldn't be around for long, presumably. But the issue, though, is do you realize that there is a contestability period? Some people do not. Relatedly, there's also a suicide exclusion period. Now, usually this is 2 years, but some states restrict it, so sometimes you'll find that it's 1 year in some states, could be less. The issue here is within that suicide exclusion period, if a person dies due to a self-inflicted injury, the insurance company may not pay the claim. They're legally allowed to not pay the claim. Now, that doesn't mean in these cases that the insurance company simply absconds with your money and keeps it. Generally speaking, if the contestability period issues in the result that they don't pay the claim, or if there's a suicide exclusion that's invoked, the insurance company will return or refund the premiums that were paid in. Whether this is with or without interest, you'd have to explore. But the point that I'm making is simply know the clauses, read through the contract, and if you have questions, raise the questions to your agent. Now, a fifth category of lack of disclosure can be with respect to the ratings that a company has. Now, sometimes insurance agents might be ignorant of their company's ratings, hopefully not, but in other cases they might choose not to report them because it would negatively impact your impression of the quality of the vehicles or instruments that they were recommending. So there are many third-party ratings organizations. Some of them would include AM Best, Fitch Ratings, Moody's, and Standard & Poor's. These ratings companies sometimes focus on different things. Not every company has a rating with every ratings organization, but when those ratings are available, they do help you to get a fix on the financial stability and security of the company that can help you make decisions about policy comparisons, if nothing else. So if an insurance agent from a low tier company comes to you and recommends replacing a policy that you have maybe from a high tier company, you might think twice about it even if their policy looks like it might be a lot better. Because in a similar way, a municipal bond, a C-rated bond, might look better in certain respects from an A-rated bond, but you're trading the potential perhaps for an increased gain over the security that you would have in a more stable instrument. Now, the sixth example is going to be what I'll call premium problems. Other of the examples that I've given have to do with cash value insurance and annuities, but in this case, this one is going to directly apply to term policies. So term policies can have a level premium, or the premium could be decreasing, the premium could be increasing. The difficulty comes in where people aren't sure what they have, or where they don't realize that what they have is liable to increase. A level premium term means that you're paying the same amount over a particular period of time. That period of time can vary. It could be 30 years, it could be 10 years. You could have an annual renewable term, which means that every single year that policy is going to get more expensive. The point is, know what you have so you're not caught unawares. When you get a notice from the insurance company that says your premium is going up, you don't want to be surprised. If you have a level premium term that covers you for 10 years, bear in mind that at the end of that 10 years, even if the policy is renewable, the premium will go up. Number 7, annuities have a number of different potential issues. We surveyed a couple of them earlier. Sometimes complicated annuities can have a great number of issues. So some annuities are market connected or indexed annuities, but in other cases, even fixed annuities can have a number of different pitfalls if you're not aware. And one of the main ones is going to be the fact that an annuity is going to have some kind of a surrender charge applied to it over a particular surrender period. Now what this means is that the insurance company is going to keep some of your money if you said, I want my money back. For instance, if you put $100,000 into an annuity and the annuity has a 10% surrender charge for the first year, let's say in 6 months you say, I changed my mind, I want my money back, then abstracting away from whatever gain you get, you're only going to get $90,000 because the insurance company is going to keep 10% of what you put in as a surrender charge. Now the upshot is understand the terms of what you are entering into, and also understand that annuities may not be the best thing if you're interested in a short-term savings vehicle. So if you knew you only needed it for 6 months, you wouldn't want to put it into a vehicle with a 10% surrender charge unless you were going to make more than that in terms of the potential gain. So sometimes the insurance agent might be concerned more with, again, his or her own interests over yours, and that can sometimes issue in recommendations to replace a policy unnecessarily. And we already looked at one case where that might be not in your best interest. For example, in a case where a lower rated company is attempting to replace a policy from a higher rated company. All things being equal, you would obviously favor the higher rated company. But even if things are unequal and the lower rated company has a slightly better deal, let's say, or better looking policy, you might still opt to go with the higher rated company simply because of their stability. But there are other things that can come into play here as well. So there is something called a reduced paid up election. So I'll say number 8 is when the insurance agent recommends that you activate a reduced paid up election for your cash value policy. And what that basically does is takes the face value down, so it reduces the face value, and it turns the policy into a paid up policy. Now, why would the insurance agent do this? Well, there can be very good reasons to perform a reduced paid up election. That's why it is an option on a cash value policy. However, there can also be self-serving reasons. So for instance, let's say the insurance agent wants to sell you a policy and you say, well, no, I don't see the need to have an additional policy. I'm already paying $100 into this one. And the insurance agent says, well, here I have this great idea. If you reduce pay up the policy you have, you can take the $100 you were paying into that old policy and put it into a new one. Now, whether or not that's a great idea or not is going to depend on your situation. If you think it's a great idea and it benefits you in some way that you understand, it might be a great idea. But if it only benefits the insurance agent, in other words, if it only gets him or her an additional policy, then it's probably something you want to question. A related situation, number 9, comes in with something called churning. So churning happens when an agent replaces a policy essentially for no other reason than to get an additional life application. So sometimes this can be done because an insurance agent might make more money on a first-year commission than he or she does on a renewal, and so they have an interest in trying to position you into a newer policy because they're going to get paid more. And another situation might arise just where, again, they recommend that you change a policy because they will get business and take it away from a different company when it doesn't benefit you. The fact that an insurance agent recommends replacement is not in and of itself cause for alarm. There are a great number of situations in which it could really benefit you, and I talk about at least a few of them in other videos. For example, in some cases, underperforming universal life policies are ticking time bombs. It can sometimes be very good to replace a policy like that before it explodes or implodes on you. However, in other cases, once again, it only benefits the insurance agent. And so you want to be really clear. If you understand how it benefits you and you agree that it does, it could be a fantastic idea. But if you don't understand, then the alarm bell should at least go off. Number 10 is going to be not comparing, I'll say, apples to apples. There can be pieces of information like the ratings of the company that the insurance agent leaves out. In many cases, an instrument or a vehicle that has the potential for higher gain is going to come with the potential for greater loss. There's often greater risk with a vehicle that's offering potentially higher gains. So the point that I'm making is you don't just want to look at one point of comparison between two contracts or two policies. You want to try and take a holistic view and look at the overall picture and try and get the best comparison that you possibly can make between whatever two policies, let's say, you're trying to decide between. Finally, I just want to underscore the fact that in some cases, misrepresentations do not stem from malice. They might also stem from ignorance. They could also stem from confusion that the agent, him or herself, might have. It's not a reason to not be aware of them, however, because they can be detrimental to you regardless of the agent's intentions. But in other cases, you might actually have a dishonest agent, and I want you to have the tools to at least be on guard a little bit. I should say that agents and brokers are required to carry what's called errors and omissions insurance. This is a kind of professional liability insurance. I mean, doctors, attorneys are going to carry malpractice insurance, and it's essentially a similar kind of a concept. I have an additional video on where to go for assistance if you think that you have been defrauded by an insurance agent. But if you found something of value in this video, I ask that you like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I'll remind you that some of the concepts that I got into here very briefly, I will expand on in other videos, or perhaps I have expanded on in other videos, and I invite you to check those out as well. I thank you so much for joining me today. I look forward to seeing you again in another video. Thank you so much.